You want to start investing, but here's the problem. If you don't have a plan, you could be setting yourself up for failure. Before you buy a single stock, ETF, or real estate property, you need to know, what are you investing for? How much risk can you handle? And when do you need your money? In this video, I'll show you how to set financial goals before investing, so you can invest with confidence, avoid costly mistakes, and actually build wealth. Stick around because at the end, I'll share the biggest mistake beginners make when setting financial goals. All right, check it out, y'all. By the end of this video, you'll know how to set clear short-term and long-term financial goals, how to measure your risk tolerance so you don't panic when the market drops, the step-by-step process to build an investment plan that works for you, and the biggest mistake that can destroy your financial future. And make sure you stick around because in the next video in this series, I'll show you exactly how to save your first $1,000 to start investing. Step 1, short-term versus long-term financial goals. Before you start investing, you need to be clear on what you're investing for. Short-term goals are typically from 1 to 5 years, and they can include saving for an emergency fund, buying a car, traveling, paying off debt. Long-term goals are typically 5+ years. Retirement planning, buying a house, building generational wealth. Short-term goals need low-risk investment, like high-yield savings accounts or bonds, while long-term goals can handle higher risk, higher reward investments like stocks or real estate. Step 2, understand your risk tolerance. Not all investments are created equal, and not all investors can handle the same level of risk. Ask yourself, how would you feel if your investment dropped 20% overnight? Low-risk investors, also known as conservative, prefer stability, like bonds, index funds, dividend stocks. Moderate risk investors are considered balanced, with a mix of stocks, ETFs, and some bonds. Higher risk investors are aggressive, chases higher growth with stock, crypto, and real estate. The key is to match your investment to your personal risk tolerance so that you're not stressed every time the market makes a move. Step 3, creating your investment plan. Now that you know your goals and risk tolerance, here's how to build your investment plan. Step 1, decide how much you can invest. Start with $10, $100, or even $1,000. The key is consistency. Aim to invest 15 to 20% of your income if possible. Step 2, choose your investment accounts. 401k or Roth IRA for retirement, brokerage account for long-term investing, high-yield savings for short-term goals. Step 3, automate your investment. Set up automatic contributions so you invest consistently. The secret to successful investing, make it a habit and not a one-time decision. Step 4, the biggest mistake beginners make. The biggest mistake, investing without a clear goal. This is what happens when you invest without a goal. You panic sell when the market drops, you chase trends and bad investments, and you don't stay consistent, leading to lower returns. A goal gives you clarity, confidence, and direction. So when the market moves, you stay focused on the bigger picture. So let's do a quick recap. How to set financial goals before investing. Short-term versus long-term goals determine your investment strategy. Understanding your risk tolerance help you choose the right investment. Building an investment plan ensures consistency and success. Avoid investing blindly. Always have a clear goal. Now, what's your biggest financial goal? Comment below. I want to hear from you. And if you're ready for the next steps in your investment journey, hit that like button, hit that subscribe button, because in the next video, I'll show you exactly how to save your first $1,000 to start investing. That's it for now. I'll see you on the next one. Peace.